When we talk about what has just unfolded, the phrase massive wealth transfer isn't some dramatic exaggeration. It's an accurate description of a process that has been building for decades and has now reached an unprecedented scale. In a matter of days, even hours, resources that belong to all of us, resources generated collectively through taxes, public institutions, and the labor of millions were moved into the hands of a narrow segment of the population. And let's be clear about who that segment is. It is not the struggling small business owner, not the average homeowner, and certainly not the worker on the factory floor or the nurse pulling a double shift. It is the largest corporations, the most powerful financial institutions, and the ultra wealthy individuals whose fortunes already dwarf the incomes of entire communities. The scale of this transfer is almost beyond comprehension because it's not just about the headline numbers, though those are staggering enough. It's about the mechanics of how this transfer is carried out. Public money raised through taxes that ordinary people pay on every paycheck, every purchase, every property bill is funneled upward in the name of stabilizing the economy. But the stabilization in question is rarely about ensuring job security, affordable housing, or accessible health care for the majority. Instead, it's about protecting the portfolios, profit margins, and asset values of those already at the top. The story is told in technical terms: liquidity injections, emergency credit facilities, market interventions to make it sound neutral, inevitable, even benevolent. But behind the jargon lies a simple truth. What belongs to the many is being handed to the few. This transfer doesn't happen in a vacuum. It happens against a backdrop of decades, long wage stagnation, and the systematic weakening of labor power. Workers have been producing more and more wealth. Productivity has skyrocketed, yet the portion of that wealth that flows back to them in wages, benefits, and security has shrunk. The gap between the value created and the compensation received has been widening, and the recent events have widened it even further. The wealth generated by millions of hands is captured and held by a small cluster of decision makers who then have the means to influence policy to keep that arrangement in place. When crises hit, whether financial collapses, pandemics, or geopolitical shocks, we're told there's no alternative but to act quickly to rescue the system. And indeed, the system is rescued. But whose system is it? It's not the public health care system gasping for resources. It's not the public schools crumbling from neglect. It's not the workers wondering how they'll pay rent next month. The system being saved is the one that measures its health in the stock market index, the bond yields, and the corporate earnings reports. In that system, the vast majority of us are bystanders, or more accurately, we are the source of the wealth, but not the beneficiaries of it. The most striking part of this process is the speed. Decades of underfunding public goods are explained away as fiscal prudence, but when the markets stumble, the taps open instantly. Trillions appear out of nowhere, not for universal childcare, not for repairing bridges, not for expanding renewable energy, but for shoring up the value of financial assets held disproportionately by the top 1%. That is how, in real time, wealth is pulled upward, leaving the rest to make do with what's left. When events like this unfold, they are often presented to the public as unfortunate accidents, the result of unpredictable circumstances, unexpected shocks, or uncontrollable forces. But the truth is that what we've just witnessed was not accidental in the slightest. It was the culmination of a long series of deliberate decisions made by individuals and institutions that understood precisely what they were doing and who stood to gain. The policies that allowed this transfer of wealth to occur did not appear overnight. They were drafted, debated, and implemented over years, even decades, with the full awareness that they would tilt the playing field in favor of those already holding the most power and resources. The narrative that this was unforeseeable serves a purpose. It shields the architects of these policies from accountability. By framing the situation as the inevitable outcome of complex, uncontrollable forces, a market correction, a global downturn, a temporary liquidity problem, those responsible are able to disguise the intentional nature of their actions. But if you examine the chain of events, it becomes clear that each link was forged by human choice. Tax codes were rewritten to favor capital gains over wages. Regulatory agencies were weakened, stripped of enforcement power, or staffed with individuals whose loyalties lay with the industries they were meant to oversee. Trade agreements were negotiated in ways that benefited multinational corporations at the expense of domestic workers. These were not accidents, they were strategies. The beneficiaries of these decisions have never been shy about defending them. They claim such measures encourage growth, attract investment, and make the economy more competitive. Yet the reality is that the growth they speak of is disproportionately captured at the top. The investment flows where returns are already highest, and the competitiveness is measured by how cheaply labor can be obtained and how lightly corporations can be taxed or regulated. The system is engineered to deliver exactly the results we are seeing, and the latest event is simply the most glaring example to date. Even the timing of interventions reveals intent. When ordinary citizens face hardship, layoffs, medical bills, foreclosure, assistance is slow, heavily means tested, and often insufficient. But when large financial institutions or major corporations encounter turbulence, the response is immediate and decisive. Emergency measures are rolled out without delay, backed by sums of money that dwarf the budgets of entire social programs. This asymmetry is not an accident of bureaucracy, it reflects priorities set long before the crisis. Those priorities were embedded in the very structure of the economy, designed to ensure that when the inevitable shocks come, the losses will be socialized while the gains remain privatized. The predictability of this outcome also undermines the argument that nothing else could have been done. If the same patterns emerge crisis after crisis, wealth flowing upward, public resources funneled to private hands, the majority left to absorb the costs, then it becomes impossible to maintain the fiction of surprise. What we are witnessing is the playing out of a script that has been written in advance with roles assigned and outcomes predetermined, all while the public is told they are simply watching an unpredictable drama unfold. For decades, there has been a widening gap between what workers produce and what they are paid, and this divide lies at the heart of the current crisis. Productivity, the measure of how much value is generated by each hour of labor, has surged to historic heights. Technological advances, improved processes, and the sheer effort of millions have driven this growth. Yet the rewards for that increased productivity have not flowed back to the people creating it. Instead, they have been siphoned upward to shareholders, executives, and owners of capital, leaving wages stagnant when adjusted for inflation. This is not a matter of oversight or temporary imbalance. It is the result of an economic system structured to reward ownership over labor, capital over effort. In the mid 20th century, productivity gains and wage growth moved in tandem. When workers produced more, they were compensated more, creating a cycle of shared prosperity. But that link was broken in the late 20th century as policy changes, deregulation, and globalization shifted bargaining power away from labor. Unions were weakened, labor protections eroded, and corporations began outsourcing and automating in ways that further undercut workers' leverage. The result was that productivity gains no longer translated into higher pay or better benefits for the average worker. Instead, those gains became windfalls for those who owned the companies, the machinery, and the intellectual property. The latest events have only amplified this disparity. As the economy falters, many workers face layoffs, reduced hours, or pay cuts. But at the same time, corporate profits remain remarkably resilient, largely because cost-cutting measures, including slashing jobs, are rewarded by financial markets. Stock prices can rise even as thousands are thrown out of work because investors see labor as a cost to be minimized, not a human contribution to be valued. The wealth generated by those cost savings is not shared with the workers who made the company viable in the first place. It is paid out in dividends used to buy back shares or reinvested in ways that further consolidate ownership at the top. This is reinforced by a tax system that privileges returns on investment over wages. While workers pay income tax on every paycheck, those whose wealth comes from dividends or capital gains often pay a lower rate, and in some cases, nothing at all. This ensures that the rewards of rising productivity are disproportionately captured by those who are already wealthy, while the majority see little to no improvement in their financial security. Over time, the gap between labor's share of income and capital's share has grown so large that it now defines the structure of the economy. The cultural narrative surrounding this divide also masks its injustice. Workers are told that if they simply improve their skills, work harder, or adapt to new economic realities, they will share in the benefits. But the data shows otherwise. Even as education levels have risen and work hours remain high, the proportion of income going to wages continues to shrink. The system is designed to ensure that productivity gains enrich the owners of assets, not the people whose labor creates them, and that is why the current crisis has intensified inequality rather than reduced it. When the economy falters, the difference in how various groups are treated becomes impossible to ignore. For ordinary people, a lost job, a medical emergency, or an unexpected expense is met with lectures about fiscal responsibility, warnings about the dangers of dependency, and a maze of eligibility requirements. Any help that is offered comes slowly, often in amounts too small to cover the real cost of survival, and is surrounded by conditions that suggest the recipient must prove their worthiness. For corporations and the wealthy, the experience is the opposite. The moment their profits are threatened, an entire machinery of rescue is activated on their behalf. Governments move quickly, central banks act decisively, and vast sums of public money are deployed to stabilize their assets and restore their confidence. This contrast is not accidental. It is the reflection of a political and economic system that has been built to respond to the needs of the powerful first. Public officials justify this by claiming that saving large corporations or financial institutions is necessary to prevent wider economic collapse. They argue that if the pillars of the economy fall, everyone else will be dragged down with them. But in practice, what happens is that the lifelines extended to these entities ensure that their owners and investors emerge intact, often stronger, while the broader public absorbs the costs without reaping comparable benefits. The metaphor of too big to fail is revealing. It implies that some are so essential that their failure cannot be tolerated, while others are small enough to be left to fend for themselves. The recent episode fits this pattern perfectly. When the markets began to wobble, liquidity programs were announced within hours, special credit facilities were established, and emergency legislation was drafted to ensure corporate stability. The speed was breathtaking. Yet during those same hours, workers were being told to wait for relief checks that would arrive weeks or months later, if at all. Small businesses were left navigating complex application processes for loans that ran out of funding before most could access them. Renters and homeowners facing eviction or foreclosure were given temporary pauses at best, with no guarantee of long-term security. The resources committed to corporate rescue are also far larger than those dedicated to direct public aid. Trillions can be mobilized overnight to protect asset prices and shareholder returns, while programs for healthcare expansion, affordable housing, or education are described as unaffordable. This is not because the money does not exist, but because the priorities are set in a way that treats corporate stability as an unquestioned necessity and public well-being as a negotiable expense. The imbalance reveals where real influence lies in the boardrooms, not in the neighborhoods, in the hands of investors, not in the hands of workers. Over time, this repeated pattern of bailouts for the wealthy and austerity for everyone else has entrenched inequality. It has created a sense of inevitability, as though economic crises must always end with the rich being made whole and the poor being told to tighten their belts. This is reinforced by the revolving door between government and industry, where the same individuals who design corporate rescue packages often come from, and eventually return to, the very companies that benefit from them. The concentration of wealth in fewer and fewer hands has brought with it an equally dangerous concentration of political power. In theory, democracy is meant to function on the principle of one person, one vote, with elected officials representing the interests of their constituents. In practice, the influence of money has distorted that process to the point where policy outcomes often reflect the preferences of the wealthiest donors and corporations rather than the needs of the broader population. Campaigns are increasingly expensive, making candidates dependent on large contributions to be competitive. Those contributions rarely come without expectations. Wealthy backers seek not only access to decision makers, but also legislation, regulation, and trade agreements that will protect and expand their economic advantages. The result is a political system where the lines between public service and private interest blur. Lobbyists, funded by industries with deep pockets, write significant portions of the laws and rules that govern those industries. Regulatory agencies, which are supposed to protect the public from corporate abuse, are often staffed by individuals who previously worked for the companies they now oversee or who expect to return to those companies after their time in government. This revolving door ensures that the mindset of regulators aligns more closely with the priorities of industry than with those of the public. Over time, it becomes difficult to separate the state from the interests of the corporate elite, as the two operate in near symbiosis. The recent transfer of wealth illustrates this dynamic vividly. The speed with which relief was mobilized for corporations and investors was not simply a matter of economic necessity, it was a reflection of who holds influence in the political hierarchy. When financial markets began to falter, phone calls were made to the highest levels of government, meetings were convened behind closed doors, and emergency measures were approved without the drawn out debates that typically accompany legislation affecting ordinary citizens. The channels of communication between the powerful and policymakers are direct, constant, and effective, ensuring that their priorities are treated as urgent. Meanwhile, the voices of the majority are diluted. Even when public opinion strongly favors policies such as raising the minimum wage, expanding health care, or implementing stronger labor protections, those measures often stall or are watered down under pressure from wealthy interests. The ability to fund think tanks, media campaigns, and political action committees allows the elite to shape not only legislation, but also the public narrative about what is possible and desirable. By controlling the terms of debate, they make structural change appear unrealistic or dangerous, reinforcing the status quo. This erosion of democratic responsiveness is compounded by the way economic inequality itself suppresses political participation. When people are working multiple jobs to make ends meet, they have less time and energy to engage in civic life, attend public meetings, or organize for change. Economic insecurity becomes a form of political disenfranchisement, ensuring that those already marginalized remain unheard. As wealth and power reinforce each other, the gap between the governed and the governing widens, creating a system where democracy functions in name but oligarchy operates in practice. The growing imbalance between the wealthy few and the rest of society is not just an abstract moral issue, it is a structural problem that threatens the stability of the entire economic and political system. Economies depend on a broad base of people with the means to spend, invest, and participate in the market. When too much wealth is concentrated at the top, demand across the economy weakens because the majority of people simply do not have enough purchasing power. The wealthy may continue to accumulate assets, but their spending cannot replace the collective consumption of millions of households. Over time, this imbalance creates fragility, making the system vulnerable to shocks and downturns that could have been mitigated by a more equitable distribution of resources. Inequality also fuels social instability. When people see the rewards of their labor consistently flowing upward while their own conditions stagnate or decline, frustration builds. That frustration can manifest in protests, strikes, or political movements that challenge the legitimacy of existing institutions. The perception that the system is rigged erodes trust, not only in governments, but in markets themselves. Once that trust is lost, rebuilding it becomes difficult, and without trust, economic cooperation weakens. The result is a cycle in which inequality breeds instability, and instability is then used as a justification for further concentrating control in the hands of a few. The urgency for systemic change becomes even clearer when considering the historical record. Societies that allow inequality to grow unchecked eventually face political upheaval or economic collapse, whether through revolutions, depressions, or waves of populist backlash. Extreme concentrations of wealth and power are repeatedly met with disruptive forces. This is not ideology, it is a recurring pattern observable across different eras and cultures. When too many people are excluded from the benefits of economic growth, they eventually reject the systems and leaders that have failed them. The recent transfer of wealth from the public to the private elite is a case study in how this process accelerates. Not only did it exacerbate the existing inequality, it also signaled to the public that the rules are different depending on who you are. For those at the top, losses are socialized and cushioned by the state. For everyone else, losses are borne individually with little to no support. This double standard intensifies the sense that the economy is not designed to serve the majority, and it makes demands for reform more urgent. Addressing this urgency requires more than incremental adjustments. Small policy tweaks or temporary relief measures may provide short term alleviation, but do nothing to alter the underlying mechanisms that transfer wealth upward. Without structural reforms in taxation, labor rights, corporate governance, and public investment, the cycle will continue, each crisis serving as an opportunity for the elite to consolidate even more control. The stakes are not just economic fairness, but the preservation of a stable, functioning society in which the benefits of prosperity are shared broadly rather than hoarded by a narrow class.